Hello, ladies and gentlemen. Welcome to NB Solve, a series where experts from Nirmal Bank will answer all your queries on mutual funds, equity, and commodity. I am Raghav Garg, research analyst at Nirmal Bank. Today's topic is banking and finance sector. So, without any further ado, let's dive into the questions that we have received. First question we have received is from Akhil Pillai, who's asking for our view on credit growth. So, as a house, we are expecting a credit growth of around 9% in FY22 and about 10 to 12% in FY23. Currently, the way things stand is that the retail growth has been doing reasonably well. What we expect is that in second half and next year, we should see some pickup in the corporate credit. So that should again add to the overall credit growth and reach about 9% in FY22 and about 10 to 12% in FY23. The second question is from Ankit Joshi, who's asking on ICICI Bank's results. NIM is at 4%. Numbers are good. Is this the right time to buy the stock and outlook? So yes, we expect ICICI Bank to continue to deliver on loan growth and earnings. We think that the low cost of funds and higher growth in the unsecured portfolio, those two things should lead to NIMs expanding even from current levels, which they've reported at about 4% for Q2 FY22. Loan growth for the bank is also expected to remain strong, being a key player in the mortgages, and the other retail segments for the bank are also performing very well. Credit costs should also trend down. That is our view, as they are carrying a very strong PCR cover along with a 20% cover on the restructured assets. So we do expect that credit costs should come down in the coming years, which should lead to better earnings. The next question is from Jurgen Thomas, who is asking whether it's time to buy PSU banks or private banks. So we would still prefer private sector banks over PSU banks broadly. Selectively, there may be some opportunities in the PSU space, such as SBI, which has been delivering good earnings, and stress baggage is also reducing for them. The challenge with most of the PSUs is with respect to the weak balance sheet capitalization, amongst other challenges, one of which is asset quality. So on the other hand, most of the private sector banks, they are still reasonably priced and they are offering good earnings visibility. As a pack, we would still prefer private banks over public sector banks. The next question is, which is the best HFC to buy and what is the time frame and target and reason, by Rishi Deshmukh. So Rishi, we like HDFC Limited the most. Mortgages as a sector still has a very large room to grow, and HDFC Limited has a very competitive cost of funds. It has a very large market share, and because of its competitive cost of funds, it is able to price its products very competitively compared to the other large players. Asset quality is also very good for the company when compared to the other large peers. If you compare the numbers to LIC or a PNB HF, their NPA ratios are lower, not only in the retail segment, but also in the developer segment. So that kind of reflects on their underwriting quality. In terms of our target and time frame, so I think we could expect the stock price to move to 3,100 to 3,200 levels in a year's time. So that's all the questions that we had received. Thank you so much for joining in the session. See you again in another interesting session of NB Solves with some more interesting questions. Have a great day, stay safe and stay invested. Thank you.